actually forecasting growth of industrial robots from 16 billion to 37 billion over the next 10 years, with 2022 being that key inflection point.
It's a year that everyone will remember. We passed the 10 trillion mark, and we've had over $1 trillion of investments.
EFT Investing Explained: the good, the bad, and the ugly. Imagine if you could invest in the most popular stocks on social media and take a position in the stock based on conversations being held daily on social media that's moving the stock up and down. Well, there's actually a way to do that in a fund, and it's an ETF. So what are ETFs? There are so many ways to invest your money to build your wealth. From stocks to bonds to index funds, there's a wide range of investment vehicles for every kind of investor, depending on their goals. A growing number of investors are using exchange-traded funds, or ETFs, to build diversified portfolios. Maybe you should consider it too, if you understand its risks and rewards. But if you don't, you're in luck, because in this video, I'll be explaining all you need to know about ETF investment, including the good, the bad, and the ugly. These popular funds, which are similar to mutual funds but trade like stocks, have become a popular choice among investors looking to broaden the diversity of their portfolios without increasing the time and effort they have to spend managing and allocating their investments. By the end of this watch, you'll decide whether it suits your style of investment or not. But first, in the comments below, tell me, would you rather invest in stocks or bonds? Now let's look at the good, the bad, and the ugly side of ETF investment. An exchange-traded fund, or ETF, is a fund that can be traded on an exchange like a stock, meaning it can be bought and sold throughout the day. ETFs often have lower fees than other types of funds. Depending on the type, ETFs have varying levels of risk. But like any financial product, ETFs aren't a one-size-fits-all solution. Evaluate them on their own merits, including management costs and commission fees, if any, how easily you can buy or sell them, and their investment quality. There are a variety of ways to invest in ETFs, and how you do so largely comes down to preference. For hands-on investors, investing in ETFs is but a few clicks away. These assets are a standard offering among the online brokers, though the number of offerings and related fees will vary by broker. On the other end of the spectrum, robo-advisors construct their portfolios out of low-cost ETFs, giving hands-off investors access to these assets. One trend that's been good for ETF shoppers is that many major brokerages drop their commissions on stock, ETF, and option trades to zero. ETFs are an easy way to gain exposure to a pool of investments without having to buy each one individually. They can track a stock market index such as the NYSE, an asset class such as government bonds, a market segment such as bonds maturing in fewer than 5 years, a region, or a sector. ETFs are referred to as passive investments, or passive funds, in that they attempt to track the performance of a market index or pool of investments, unlike active funds, which try to beat the index. ETFs are also known as open-ended investments rather than closed-ended ones. This means that new shares are created when money is invested in the fund. When money is withdrawn, units are redeemed. ETFs, like all exchange-traded products, are traded on a recognized stock exchange. Some of the key attractions of investing in ETFs are low cost, transparency, flexibility, and choice. Unlike a unit trust, which trades at one set price point during the day, ETFs can be traded whenever the stock exchange is open. This makes them a flexible way of investing. Investing in ETFs also makes it easier to diversify your portfolio. For example, buying an ETF that tracks the S&P 500 is comparable to buying a small part in the appropriate proportion of each of the index's 500 companies, all at a much lower cost than would be feasible for an individual, given the commissions charged for each trade and the capital required. ETFs unlock diversification for investors because they typically follow broad-based and well-diversified indices, spreading the risk of your investments across many securities. ETFs may trade like stocks, but under the hood, they more resemble mutual funds and index funds, which can vary significantly in terms of their underlying assets and investment goals. There are various types of ETFs. Firstly, we have stock ETFs. These comprise stocks and are usually meant for long-term growth. While typically less risky than individual stocks, they carry slightly more risk than some of the others, such as bond ETFs. Secondly, there is commodity ETFs. Commodities are raw goods that can be bought and sold, such as gold, coffee, and crude oil. Commodity ETFs let you bundle these securities into a single investment. With commodity ETFs, it's especially important to know what's inside them. Do you have ownership in the fund's physical stockpile of the commodity, or own equity in the companies that produce, transport, and store these goods? Does the ETF contain futures contracts? Is the commodity considered a collectible in the eyes of the IRS? These factors can come with serious tax implications and varying risk levels. Bond ETFs are the third type. Unlike individual bonds, bond ETFs don't have a maturity date, so the most common use for them is to generate regular cash payments to the investor. These payments come from the interest generated by the individual bonds within the fund. Bond ETFs can be an excellent lower-risk complement to stock ETFs. Then we have international ETFs. Foreign stocks are widely recommended for building a diverse portfolio, along with U.S. stocks and bonds. International ETFs are an easy and typically less risky way to find these foreign investments. These ETFs may include investments in individual countries or specific country blocks. Lastly, we have sector ETFs. The U.S. stock market is divided into 11 sectors, and each is made up of companies that operate within that sector. Sector ETFs provide a way to invest in specific companies within those sectors, such as the healthcare, financial, or industrial sectors. These can be especially useful to investors tracking business cycles, as some sectors tend to perform better during expansion periods, others better during contraction periods. Often, these typically carry a higher risk than broad market ETFs. Sector ETFs can give your portfolio exposure to an industry that intrigues you, such as gold ETFs or marijuana ETFs, with less risk than investing in a single company. One of the potential downsides of an ETF is that because it doesn't always hold every asset in the index that it's trying to replicate, there'll be a slight difference between its performance and that of the index. Although this tracking difference can work in an investor's favor, it can also work against them. All investments carry risks, and this is no different for ETFs. ETFs, like mutual funds, are often lauded for the diversification that they offer investors. However, it is important to note that just because an ETF contains more than one underlying position doesn't mean that it's immune to volatility. The potential for large swings will mainly depend on the fund's scope. An ETF that tracks a broad market index such as the S&P 500 is likely to be less volatile than an ETF that tracks a specific industry or sector, such as an oil services ETF. Therefore, it's vital to be aware of the fund's focus and what types of investments it includes. As ETFs have continued to grow increasingly specific along with the solidification and popularization of the industry, this has become even more of a concern. In the case of international or global ETFs, the fundamentals of the country that the ETF is following are important, as is the creditworthiness of the currency in that country. Economic and social instability will also play a huge role in determining the success of any ETF that invests in a particular country or region. These factors must be kept in mind when making decisions regarding the viability of an ETF. The rule here is to know what the ETF is tracking and understand the underlying risks associated with it. Don't be lulled into thinking that just because some ETFs offer low volatility, all of these funds are the same. Again, it's always important to remember that the biggest factor in an ETF, stock, or anything else that is traded publicly is liquidity. Liquidity means that when you buy something, there's enough trading interest that you'll be able to get out of it relatively quickly without moving the price. If an ETF is thinly traded, there can be problems getting out of the investment, depending on the size of your position relative to the average trading volume. The biggest sign of an illiquid investment is large spreads between the bid and the ask. It would help if you made sure an ETF is liquid before buying it, and the best way to do this is to study the spreads and the market movements over a week or month. The rule here is to make sure that the ETF you're interested in does not have large spreads between the bid and the ask prices. In some cases, an ETF will distribute capital gains to shareholders. This is not always desirable for ETF holders, as shareholders are responsible for paying the capital gains tax. It's usually better if the fund retains the capital gains and invests them, rather than distributing them and creating a tax liability for the investor. Investors will usually want to reinvest those capital gains distributions. And to do this, they'll need to go back to their brokers to buy more shares, which creates new fees. Because different ETFs treat capital gains distributions in various ways, it can be a challenge for investors to stay apprised of the funds in which they take part. It's also crucial for an investor to learn how an ETF treats capital gains distributions before investing in that fund. Once you've determined your investment goals, ETFs can be used to gain exposure to virtually any market in the world or any industry sector. You can conveniently invest your assets using stock index and bond ETFs and adjust the allocation in accordance with changes in your risk tolerance and goals. You can add alternative assets such as gold, commodities, or emerging stock markets. You can move in and out of markets quickly, hoping to catch shorter-term swings, much like a hedge fund. The point is, ETFs give you the flexibility to be any kind of investor that you want to be. Innovation has been the hallmark of the ETF industry since its beginnings more than 28 years ago. Undoubtedly, there will be new and more unusual ETFs introduced in the years to come. While innovation is a net positive for investors, it's important to realize that not all ETFs are created equal. You should investigate carefully before investing in any ETF, carefully considering all factors to ensure that the ETF you choose is the best vehicle to achieve your investment goals. And that's it from us today. Would you consider investing in ETFs? Let me know in the comments below.